When lenders evaluate a credit report, one of the factors they often consider is the age of the accounts listed in the profile. Account age refers to how long a credit account has existed, and this information helps lenders understand how much experience a borrower has managing credit over time. The topic of this lesson, why account age matters in credit profiles, is about understanding how the length of credit history influences the way lenders interpret financial behavior. Credit reports function as timelines that record financial activity month after month. Each account listed in the report contributes to that timeline by showing when the account was opened and how it has been managed since that date. When lenders review the report, they often examine the age of accounts because longer histories provide more information about how consistently credit has been handled. For example, an account that has been open for 10 years with a strong record of on-time payments may signal stability and reliability. That long timeline demonstrates that the borrower has managed the account through different financial circumstances over an extended period. In contrast, a newly opened account may provide less information because the payment history is still limited. Another important concept related to account age is the average age of accounts. Credit profiles often contain several trade lines representing different financial relationships. Some accounts may be older, while others may be relatively new. The average age of accounts represents the overall maturity of the credit profile by combining the ages of all accounts within the report. Lenders sometimes review this average to determine whether the borrower has a long-established credit history or a relatively new one. Profiles with longer average account ages may signal greater experience managing credit obligations because they reflect relationships that have existed for extended periods. Shorter average ages may suggest that many accounts were opened recently, which could indicate a period of increased borrowing activity. Account age also interacts with other elements of the credit profile. For instance, an older account with consistent payment history may strengthen the overall profile by demonstrating long-term reliability. A newer account may still contribute positively if payments are made consistently, but it will take time before that account develops a substantial history. This gradual development explains why credit profiles often improve slowly as accounts mature. Each additional month of positive activity adds another data point to the timeline recorded within the report. Over several years, these entries accumulate into a detailed record of financial behavior that lenders can analyze when evaluating risk. Another reason account age matters involves stability within the credit profile. When accounts remain open for many years, they contribute to the continuity of the financial history recorded in the report. Closing older accounts may sometimes shorten the average age of accounts within the profile, which could change how lenders interpret the report. However, the impact of closing accounts can vary depending on the specific structure of the credit profile. In some cases, closing an account may have little influence if several other long-standing accounts remain active. Understanding this interaction requires analyzing the entire credit profile rather than focusing on a single account in isolation. Within the credit strategy framework, account age is considered one of several patterns that help explain how lenders interpret credit reports. Instead of viewing the credit report as a static list of accounts, the framework encourages consumers to recognize that each account contributes to a developing financial timeline. The longer that timeline becomes, the more information lenders have available when evaluating financial behavior. For this reason, older accounts often carry significance because they represent years of recorded activity that demonstrate how obligations have been managed. This does not mean that newer accounts are inherently negative. New accounts can also contribute positively as long as they are managed responsibly. However, they require time to build the history that lenders rely on when assessing reliability. Understanding the importance of account age helps consumers see why credit improvement is often a gradual process rather than an immediate transformation. Credit profiles develop month by month as payment history grows and accounts mature. Each new entry in the timeline adds more information about how credit has been used. By recognizing this gradual evolution, individuals can approach their credit reports with a more realistic perspective and focus on maintaining consistent financial behavior over time. Instead of reacting to short-term changes, they can observe how their credit profiles develop as accounts age and positive history accumulates. This long-term perspective allows consumers to interpret their credit reports more accurately and understand why lenders often view longer credit histories as indicators of stability within the broader financial profile.